Good afternoon. Today is Thursday, May 20th, 2010, and the market got hit pretty hard here today. Finished right on its lows at 107.54, down 3.78%. And actually, just right now at 5:15 Eastern, I'm looking at the market is actually trading down at 106.84. So losing another 30 cents or so here after hours. So tomorrow's going to shape up to be a bad opening as well. We certainly saw it close very weak here with strong volume selling right at the close today. And today we had heavy volume. Now, a lot of attention was made about the market closing below the 200-day moving average. And I want to point out over at my blog at alphatrends.net that it's not really, it's more the direction of the 200-day moving average that matters than whether we close below it for a couple sessions. So be sure to go take a look at alphatrends.net for that. But I also wanted to point out here some of the previous occasions. So for instance, you can take a look at 1999 here, and we can see where the market got below this 200-day moving average, crossed back up. The direction of the 200-day moving average was advancing. In 2000, we had it crossed down a couple times through there. It wasn't until the 200-day moving average was declining that it really mattered and led to this bigger sell-off in 2001. And then we got above it briefly, the 200-day moving average in 2002, but that 200-day moving average was still declining. So that's important to notice, is what's the direction. When the market got back above the 200-day moving average and it started advancing in 2003, that signaled the beginning of a new bull market, and we remained above it until in 2004 we dipped below a few times, but the market then soared higher, and it was again the direction of the 200-day moving average remained higher. 2005 we had kind of a choppy year, but the 200-day moving average was advancing. We spent some time below it. So the point here is the same thing in 2006. The 200-day moving average was advancing. We spent some time below it, but then the market, that which didn't kill it only made it stronger, and we saw a massive rally in 2006 that led into 2007. We started seeing more volatility and more crosses below that 200-day moving average. And then in 2008, when we crossed below it and it started declining, then it acted as resistance in May of 2008. That's when we knew we were in for bigger trouble. So here we are back to the 200-day moving average. Now, the point is, it doesn't mean you go out and buy this market, but it's not a good time to become bearish, I think, after the market's already dropped 11% over the last 3 weeks. What we want, and then it's taken out this 200-day moving average that a lot of people look at. Realistically, it's an amateurish way of looking at the market. The more appropriate way to look at the market is using multiple time frames and looking at it and saying, we've been below this declining 5-day moving average. We're below the 10 and the 20, and they're declining. We've known since the break of that 118.50 support that this market is in trouble, has been in trouble, and to get bearish now just doesn't make sense. You should have already been bearish. So looks like we have more selling ahead. It's tough to say what this market's going to do. We could come down to the 105 level, and we could continue to just slide from there. But tomorrow's going to be an interesting day. We've got the market gapping lower here as it is, and we're below the declining 5-day moving average, and that's really, when we're below that declining 5-day moving average, lower highs and lower lows, it's guilty till proven innocent. The market has lost a lot of ground in a very short period of time, and it's likely that we'll encounter a strong snapback rally sometime over the next 1 to 5 sessions, I would think. But it's going to you're going to have to be looking at the 1-minute time frames and expect to get stopped out a couple times if you're trying to pick that bottom. It's really a dangerous game, and this is a market that, as I've been saying for a couple weeks, that most people should not be involved in.